Welcome to the Deep Dive.
Hello.
This discussion, prepared by EduKnit, dives right into a really critical debate in financial reporting. We're talking about how companies classify goodwill impairment.
Yeah, it sounds technical, but stick with us. If you need to get your head around financial performance under IFRS, this is key. We're basically asking, is goodwill impairment an operating thing or an investing thing?
And here's the kicker, the really interesting part. The source material we're looking at argues pretty strongly that putting goodwill impairment under operating, which is what most companies do now, actually misrepresents how the company is really performing day to day.
It's a big claim.
Yeah.
So let's start at the beginning. What even is goodwill?
Right. Back to basics for a second.
Okay, so goodwill. It's essentially the extra money, the premium you pay when you buy another business over and above the fair value of its identifiable net assets. The tangible stuff and the specific intangibles like patents.
So it's the price of buying growth rather than building it yourself, non-organic growth.
Exactly. And there's also the other side, the bargain purchase game. That's when you manage to buy a company for less than its net identifiable assets are worth. A discount, basically.
Both sides of the same coin, paying more or paying less than the sum of the parts.
Precisely. And the rule here under IFRS 3 is super clear. Goodwill only comes from one place.
Yeah.
Buying a business. It's an investment decision.
You can't, decide your own brand is suddenly worth millions more and just add goodwill to your balance sheet?
Nope. IFRS 3, paragraph 48, explicitly forbids recognizing internally generated goodwill. Doesn't matter how awesome your brand becomes organically. If you didn't pay for it in an acquisition, it's not goodwill on the books.
So what does that premium, that goodwill, actually represent? What are you paying extra for?
Well, it's all the stuff that's valuable but hard to pin down separately. Think brand reputation, strong customer relationships, maybe a really skilled workforce.
Expected synergies too, right? Like cost savings or cross-selling opportunities you hope to get after the merger.
Absolutely. Future economic benefits that you, the acquirer, expect to flow from combining the businesses. That's often a huge part of the justification for the price.
Okay, so the key takeaway here is goodwill, whether it's a premium or that bargain purchase discount, originates exclusively from a strategic investment decision. It's capital allocation.
That's the foundation laid out in the source material. It's an investment, plain and simple.
All right, so goodwill is now on the balance sheet. It came from an investment, unlike, say, a machine. It's not amortized each year. So how does its value change over time?
Good question. Primarily two ways, and again, both link back to that initial investment. First, there's contingent consideration adjustments.
Like earnouts based on future performance.
Exactly. If the deal included payments conditional on hitting certain targets, and the estimated value of those payments changes within the measurement period, usually the first year, you adjust the goodwill amount retrospectively. IFRS 3 covers this. It's essentially fine-tuning the purchase price.
Still part of nailing down the cost of that initial investment? Makes sense. What's the second way?
That's the big one for our discussion, impairment testing. Under IAS 36, companies must test goodwill for impairment at least once a year.
Or more often if something happens that suggests its value might have dropped.
Correct. If there are indicators of impairment, maybe a key market collapses or technology shifts. This testing happens at the level of the cash generating unit, or CGU.
The CGU, remind us.
It's the smallest group of assets within the company that generates cash inflows mostly independently from other assets. So, you allocate the goodwill to the CGUs expected to benefit from the acquisition.
And impairment strikes when?
Impairment happens when the carrying amount of that CGU, what it's worth on the books, including its allocated goodwill, is higher than its recoverable amount.
Recoverable amount being the higher of its fair value, less cost to sell, or its value in use.
That's the one. If the recoverable amount drops below the book value, you've got an impairment loss.
What usually causes such a big drop? Is it always external shocks?
External factors can play a role, definitely. Economic downturns, loss of key people, tech changes. But the source material really highlights that quite often the most common cause is internal. It's the failure of the acquisition thesis itself. Meaning the acquirer realizes they just plain overpaid. Or, maybe more frequently, those expected synergies, the cost savings, the cross-selling, the combined innovation, they just don't happen.
The very reason they paid that premium in the first place vanishes.
Exactly. The hoped-for benefits didn't materialize. The investment didn't deliver what was promised in the M&A pitch deck.
Okay, so goodwill comes from investment, and impairment often comes from that investment thesis failing. Which brings us right back to the central problem.
The classification dilemma.
Why is this loss stemming from a past investment decision failure currently being reported alongside day-to-day operating results?
That's the core argument in the source.
Yeah.
Current IFRS practice usually sees this impairment charge hit the operating income line. But the analysis argues this fundamentally misrepresents performance because it mixes apples and oranges.
Let's tackle that single economic unit idea, though. Someone might say, look, once I buy a company, it's part of my operations. If that part underperforms, even the goodwill part, isn't that an operational failure?
That's a fair point to raise, the idea that post-acquisition, it's all one big happy operational family. But the source material really pushes back on this. Let's use that pharma biotech example you mentioned earlier because it makes it crystal clear.
Okay, walk us through it.
Imagine big pharma buys small biotech co. They pay a huge premium, tons of goodwill, almost entirely based on expected R&D synergies, hoping for blockbuster drugs down the line.
Right.
Now, post-acquisition, the original small biotech co business keeps ticking along nicely, selling its existing products, maybe some diagnostic tools. Operationally, judged purely on its own activities, it's profitable, good margins, efficient operations.
So the day-to-day is fine.
But after a few years, it becomes clear those amazing R&D synergies, they're not happening. Maybe the cultures clash, key scientists leave, the integration just fails. The whole strategic reason for paying that massive premium has evaporated.
So the value justifying the goodwill is gone, even if the original core business is okay.
Exactly. So under IAS 36, you have to impair the goodwill allocated to that CGU. The recoverable amount, based now just on the steady but unspectacular existing business, is way lower than the carrying amount, which includes that big chunk of now worthless synergy-based goodwill.
And that impairment charge could be huge.
Massive. But here's the point. Charging that massive loss against operating income makes it look like the entire group's day-to-day operations suddenly became terribly inefficient.
When really the underlying biotech operations are doing okay, it's the strategic investment decision from years ago that failed.
Precisely. It obscures the true picture. You can't tell if management is doing a good job running the core business if the results are swamped by the write-off of a past M&A gamble. It reduces the usefulness of that operating income figure.
Analysts looking at EBITDA or operating profit wouldn't get a clear signal about recurring performance. It impacts bonuses tied to operating results, debt covenants.
All of that gets distorted. You're mixing a capital allocation failure with operational execution success or failure.
So the source argues this isn't just theoretical. It has real consequences for how people use the financial statements.
Absolutely. And then it brings up a really compelling comparison. The treatment of investments in associates under IAS 28.
How does that work and why is it relevant here?
Okay, when you buy significant influence, usually 20–50% in another company, an associate, any goodwill paid is actually embedded within the total carrying amount of that investment on your balance sheet.
So it's not shown as a separate goodwill line item like with a subsidiary?
Correct. It's bundled in. And when you test that entire investment in the associate for impairment, you're testing the whole thing as one asset, including that sort of imputed portion of goodwill within it.
Okay, so the goodwill value is still part of the impairment test. What about the classification of any profit, loss, or impairment from that associate?
This is the crucial point. The share of the associate's profit or loss and any impairment loss recognized on that investment is typically presented separately from the main operating results. Often below operating income, maybe in a line like share of profit loss of associates, or grouped with other investing type items.
So the loss arising from the decline in value of an associate investment, which includes its embedded goodwill component, is already treated as non-operating.
Yes. The source argues this creates a major inconsistency. If the impairment related to goodwill embedded in an associate investment is treated as not operating, why on earth would the impairment of explicitly recognized goodwill from acquiring a subsidiary which stems from the exact same kind of strategic investment decision be jammed into operating results?
That seems, well, inconsistent is the polite word. It feels like a contradiction in the standards.
It does. It fails the consistency test. The argument is that the classification should follow the nature of the item. And goodwill, from start to finish, is about investment.
Does the conceptual framework back this up, the overall principles of accounting?
It does. The framework talks about classification reflecting the nature and function of items, and crucially, about faithful representation.
Meaning the numbers should reflect the economic reality.
Exactly. And the source argues that putting goodwill impairment into operating income fails the substance over form test. The economic substance is a loss on a capital investment, not a cost of running the day-to-day business. Treating it as operational doesn't faithfully represent what's actually happening in the company's operations versus its strategic investments.
So we've got inconsistency with associates, a substance over form issue, distortion of key operating metrics. What's the proposed fix?
It's logical, really.
Yeah.
The source material suggests, respectfully but firmly, that for consistency, for faithful representation, for alignment with the conceptual framework, both goodwill impairment losses and those bargain purchase gains we mentioned earlier.
The discount you get sometimes.
Right. Both should be classified as part of investing activities in the statement of financial performance. Take them out of operations altogether.
And the result of that change?
Clarity. Much greater clarity. Stakeholders, investors, lenders, analysts, even internal managers could finally draw a clean line. They could see the results from management running the business,
Operational execution.
separately from the results of management making big strategic acquisition decisions.
It allows you to judge the operational teams on operations and the M&A strategy teams on their capital allocation track record.
Precisely. Better accountability, better analysis, more useful financial statements. It just aligns the accounting with the underlying economic events.
Okay, that makes a compelling case. Now, for a final thought for you, our listeners, something to mull over. The source points out something interesting about the standard setting process itself.
Yeah, apparently while this issue has been discussed, especially around the new IFRS 18 standard on presentation, the IASB, the International Accounting Standards Board, has said they don't currently have an active project specifically to fix this goodwill classification issue.
And why not?
Because, according to the IASB, they had not heard concerns about the matter from other stakeholders.
Which leads to a really provocative question for you. If you agree that this classification potentially distorts performance, how much noise does it take? How much collective voice from finance professionals, from analysts, from preparers is needed to get something like this onto the IASB's agenda for change?
It really highlights that standards evolve based on stakeholder feedback. If the community sees a problem, especially one impacting faithful representation as argued here, it needs to speak up.
Food for thought indeed. Well, that was our deep dive into the goodwill impairment classification debate. A complex area, but hopefully we've given you a clear roadmap to understanding the arguments.
This deep dive was prepared by EduKnit. Thanks for tuning in.